Hi, welcome to On Investors' Minds. I'm Tai Hui, the Chief Market Strategist for Asia Pacific at JP Morgan Asset Management. And thank you for giving us a few minutes of your time to understand what investors are thinking about right now and how that fits in with building the right portfolio. So Asian equities have a much better 2025 compared to previous years. If you look at MSCI Asia ex-Japan, it's up about 25% since the start of the year. If this were a full year, this would have been the best performance since 2017. Markets like China, Korea, Taiwan have actually outperformed the US S&P 500. So where do we go from here? Is this rally sustainable? In this episode, I'm delighted to be joined by our Senior Portfolio Manager and also the co-head of the Asia Pacific Equity Investment Team, Mark Davis, who will share with us his insights on the outlook of Asian equities. Mark, welcome to this podcast.
Thank you for having me.
Great. So let's start off with the US dollar. We've seen a US dollar weakening in the first half of this year. It's been a bit of a consolidation. And we do expect the dollar to weaken further in the medium term. It is still overvalued despite the weakening we've seen earlier in the year. And we've seen global investors starting to reduce their really super overweight on US equities. Historically, we've seen a weaker dollar prompting more global capital flow into emerging markets and Asian equities. So that's the good news. But some investors are also concerned that strong Asian currencies could undermine profit margin of many of the Asian exporters. And frankly, there are a lot of, especially Northeast Asian markets, where Asian companies are export-oriented. So how do you address this concern?
Well, I'd say a couple of things, Tai. Firstly, you're entirely correct that the weakening dollar is generally good, or has been good historically, for Asia-Pacific equities. Perhaps the most dramatic period was the bull market of the early noughties, so the beginning of this century, where the dollar was pretty weak throughout that decade, and obviously Asian and emerging market equities were on a tear in that period. Regarding the current strength of local currencies, that has some negative impact, yes. So you look at Taiwan in particular, we're seeing some earnings cuts purely on the translation effect. But the key importance of a weaker dollar is not to do with competitive exports. It's to do with the fact that local central banks in Asia no longer need to run their monetary policy with one eye on the exchange rate. So they, in the past, in order to keep their exchange rate stable versus the US dollar, they've had to run maybe higher or rather tighter monetary policy than they otherwise would have. Now they don't need to worry about that. So we've seen rate cuts everywhere throughout Asia, from Australia to Thailand to Indonesia to China to India. Everyone's cutting rates, and they have the freedom now to do that because they don't have the currency to worry about. So in that respect, a weaker dollar means looser monetary policy domestically in Asia, better liquidity, lower cost of capital for domestic companies.
That's great. I think the other aspect or the other angle would be you do have strong performance in exports. For example, you mentioned Taiwan earlier. Sure, the Taiwan dollar has been strengthening quite significantly, but at the same time, if you look at overall export growth this year, it's been around 30%. And obviously a lot of that is due to the AI boom, which we'll come back to in a moment. So what a lot of these Asian exporters are facing, as you rightly said, the challenges on the translation FX risks is offset, maybe more than offset, by the strength of their revenue growth over the short term. I think the other challenge or anxiety many investors have early this year is obviously on tariffs. President Trump, Liberation Day, obviously announced a number of tariffs on really the global economy. And we still have some lingering concerns on specific sectors, specific products like pharmaceuticals, semiconductors. And as a result, we have seen some swings in Asian export performance, but at the same time, Asian equities seem to have shrugged that off quite well. Why is that? And how does your team's allocation reflect on the risks of tariffs and also really just broader trade barriers and the whole theme of not deglobalization, but a reshuffling of global supply chains?
Yeah. So the tariffs, as announced on Liberation Day, as it was called back in April, were obviously very, very negative at the headline level. Fortunately, a lot of those tariff levels were rolled back. the sort of taco trade that ensued over the next month. So the reality is the tariffs that hit were not as bad as the tariffs that were announced. The big one, China, is yet to be decided. So we don't yet know what the final tariff will be there. But clearly China's exports as a share of global trade have continued to rise. So there's no evident near-term impact that this is having a sort of negative effect on China's share of trade. Some of that is front-loading, obviously, people buying ahead of the tariff result, but overall, the export competitiveness of China in particular has remained very strong. And there has been a rewiring. So there's been several phases of rewiring of the global trade system. Most recently, China's exports have maybe been rerouted to what's generally known as the global south. So emerging markets more broadly, Southeast Asia in particular. China now trades more with Southeast Asia than it does with the US. Now, some of that trade may be intermediary trade, it may be trade in transit going on somewhere else, but nonetheless, there has been a shift in trade patterns. If you go back further, though, the first Trump administration in 2018, when he first talked about tariffs and the threat of higher restrictions on trade, it prompted a re-examination on vulnerability of supply chains. So there was the China Plus One trade, which was effectively multinational companies realizing they couldn't have all their eggs in the China basket. They had to have, yes, manufacturing bases in China because that was the most efficient place, most productive, cost-effective place to do it, but they had to have security of supply chains as well. So they had to have some of their manufacturing bases outside of China, and countries like Vietnam and Mexico were big beneficiaries of this. Now, I think that's still very much the case. But the fact is that China's share, as I said earlier, China's share of manufacturing remains extremely strong. The other part of this, the response to the 2018 trade war, was that China decided to make itself more autonomous, more self-reliant in terms of key inputs. Now, the most high profile of those was semiconductors, where China's been trying to build up its own semiconductor industry. But across the board, I think Xi Jinping referred to it as dual circulation, where China wanted to be highly competitive at an export level, but also highly self-reliant domestically. So I think a nice way of summarizing it is China wants the world to be dependent on China, but wants China to be independent from the world.
Great. So I think there's a really important and interesting point where you've got China, who's also transforming their economy, how it operates, how it relates to global trade. And of course, multinational companies are also, as you rightly said, rewiring the supply chain. So, if I take a big step back when it comes to how the world's going to work in terms of trade, I think the North Star that I often look at is if global consumers still want a good deal and global companies still wants to make good money, globalization still works. It's just a matter of repositioning themselves in finding the most efficient, the most effective ways to deliver products to their customers. And but I think, coming back to your point on China, clearly since 2017, the Chinese economy and the government has been rewiring itself to be more self-sufficient. As you rightly pointed out, the semiconductors industry is clearly one of those shining examples. At the same time, you've got other industries like electric vehicles, renewable energy, although the profitability in those sectors are somewhat more challenging. And frankly, the Chinese equity markets have gone through a really hard time. Since 2020, we've had the reshaping of the tech sector in the regulatory framework. We had the COVID pandemic, and then we've had the really economic downturn led by the housing market, led by local government debt challenges. But as we said at the start, 2025 has been a much better year. Frankly, 2024 has been a good year for Chinese equities. 2025 is a better year for Chinese equities. Why is that? And do you think that rally that we've seen so far is sustainable?
Yeah. So one thing to remember about China is the economy is not the stock market. The stock market is not the economy. So China over the last 12, 13 years prior to this year recorded very strong GDP growth. Now, whether or not you trust Chinese GDP stats, that's a different issue, but nonetheless, the headline numbers were very strong, but the stock market didn't perform well at all. So the reason the stock market became detached from the economy was because earnings growth simply was not there. And the primary reason for that is that a lot of China's earnings growth, or a lot of China's growth was too capital intensive. So a lot of debt was piled on. There were diminishing returns on capital, diminishing incremental returns on capital. For each dollar you put in, you get progressively less out, because China has a very investment-led growth model, which works very well at early stages of development, less well when you've built sufficient numbers of highways, power stations, high-speed train lines, airports, you name it. So there were major concerns about excess capacity, deflation, and the absence of enough ammunition in the toolkit to address that. So in September last year, there was a pronouncement from the Chinese authorities that they recognized the issue and they were going to do something about it. This led to a huge stock market rally in September, October of last year. Now, when we actually look back and examine what policy responses were taken, actually it's been pretty thin gruel. It's been more incrementalism, it's been lowering of reserve ratio requirements in the banking system, a few rate cuts, a few easing of property measures here and there, a little bit of subsidies to buy some new sort of air conditioners or electric vehicles. So none of this is game changing. None of this is going to really improve the picture in China. So the first big spike in Chinese performance came on high expectations of policy response, and those expectations were disappointed. The next rally came with the announcement of DeepSeek, and that was a bit more interesting because the funds that flowed into the market in China were not the traditional national team funds, the sort of state-directed insurance companies and pension funds. It was genuine animal spirits, retail investors, especially buying Hong Kong equities through the Connect to get access to companies like Tencent and Alibaba, and companies that Chinese investors thought would be the winners out of Chinese AI. And that AI theme has broadened out to include, we mentioned the semiconductor sector earlier in China. So at the moment, if you look at the US, the Mag 7, or rather let's just narrow it down to the 4 big cloud service providers in the US, are spending this year $350 billion. That's their projected capex on GPUs, servers, and all the equipment that goes into that and supports that. Now that's a huge amount of capex. The Chinese AI capex is a fraction of that, but it's going up. And Alibaba just had a big analyst day in Hangzhou this week, and they confirmed that they're spending billions more than expected, and other players in the Chinese AI scene will do the same. So suddenly there's a recognition that it's not just the Alibabas and Tencents and Baidus of this world who are going to do well. It's that entire ecosystem that has built up from semiconductors to testing to optical equipment to server manufacturing. All the things that have done very well in Taiwan and Korea and Japan, onshore, there's a China domestic ecosystem developing, and that is also powering the market in China now. That was the second point. The third point is more akin to the supply side reform that we saw back in 2015, 2016. Now, it has the rather clunky name of anti-involution.
That I have to explain to a lot of my overseas colleagues what that means.
Yes, none of us really know what it means, but it's essentially supply side reform. Involution is another way of saying excessive race to the bottom, self-defeating price competition. So in economies plagued with excess capacity, you just have companies slashing prices and undercutting each other, and in the end, no one benefits, and it has a very deflationary impact. And you've seen, Chinese PPI has been negative for years. So there's a recognition that this is obviously not a desirable state of affairs. The Chinese authorities have looked at Japan for a long time. They've learnt some important lessons. They don't want to repeat that experience. So anti-involution is a way to instill a bit more pricing discipline in the services economy. I think one of the key areas that we're looking at is food delivery, where there's this big price war going on right now, and quick commerce, but also in manufacturing, where frankly the excess capacity is at its most extreme. So the market is hopeful that capacity will be taken out across a number of sectors, from steel to electric vehicles to batteries to lithium. And this will result in higher margins, higher returns on capital, and a better experience for shareholders. Now, if this does happen, that will be fantastic. But I have to say we're very early on in this process, and the evidence is mixed. One of the reasons the evidence is mixed is because back in 2015 and 16, the industries that the state was instructing to reduce capacity were very much state-owned enterprises, and it was easier for them to pull those levers. Now it's more, these are more private companies. It's more kind of moral suasion rather than direct orders. And it remains to be seen how rapidly a lot of these private businesses actually adjust capacity, because it's all very well saying, we accept there's too much capacity, it needs to be cut, but it's difficult to say, and I'm the one who should cut it. I'm the one who should shrink my business. Also, these policy measures work well in China, where the central government and local governments are aligned, where the central government recognizes there's a problem and wants a reduction in capacity. That's great, but the local government will say, well, fine, but these are factories in my province, and this means unemployment, and this means issues I have to face with, and bad debts from write-offs and things like that, which they'd rather avoid. So it's understandably going to be a complicated process.
No, I completely agree with that. I think the one thing I'm trying to wrap my head around is, if you look at the experience of governments around the world, they typically spend a lot of time trying to reduce monopolistic behavior. They don't often need to reduce excessive competition. So in that sense, I think there's a lot of academic studies, a lot of practical experience on how to break up companies to enhance competition. But there's been a lot less of that in going the other way. I think the other point you touched on, which is the unintended consequences of these exercise. What does that mean for companies that may go under? Their bank loan exposure, their investor exposure, the consequences on the job market. I think that's something, again, I completely concur with the view that there should be more sensible competition, but given where things are right now, to unwind the excessive competition, there could be some pains along the way. So I think that's a balance that needs to be struck by the government. Okay, so China's done very well this year. And as you rightly pointed out, I think the return of AI and also really a new lease of life for a lot of the tech companies, which frankly have been under policy uncertainties for the past few years. I think that's a big change from China's perspective. Another market that have gathered a lot of attention over the past few years is India. Again, India's done really well in the past couple of years. A lot of strong expectations on structural growth. They have a large, young, dynamic population. And as a result, there's a lot of optimism on the long-term growth prospects for India. This year has been somewhat disappointing, partly because the currency has not performed as well as other Asian currencies. Some would also argue that its relationship with the US have taken a surprisingly bad turn. 50% tariffs, and then the latest H-1B visa issue. What's your take on India, and what are some of the potential catalysts for the Indian market to perform better, not necessarily 2025, but over the next 3 to 5 years?
Yeah. Okay. So firstly, I think the US relationship, the 50% tariffs, and the H-1B visa issue. H-1B visas is relevant to the IT services sector, but it's definitely not existential for them. It's a hiccup. The tariffs more broadly, India is not a particularly trade-exposed economy, and the tariffs are unwelcome, but they're not going to derail the India growth story, and I'm sure they will reach some sort of accommodation sooner rather than later on that. The problem with India's recent performance is just where it came from. So we've seen this big domestic bull market in India over the last few years, and that was built on a basis of really sensible long-term economic reforms that the Modi government put in place in his first two administrations. So the digital banking, the demonetization, the creation of a genuine internal market in India, the goods and sales tax, rather than just the each individual state having their own customs regimes. So all of this was pro-growth, and after COVID, or at least during COVID, there was a huge amount of government subsidies and handouts, which ended up sort of helping people to sort of tide themselves over during that difficult period, and led to a degree of pent-up consumption, as we saw in a lot of other markets after COVID. So on top of this, there was a genuine capex cycle that started for the first time in about a decade, some 3 years ago. And this led to a lot of enthusiasm, particularly by Indian investors. So for the first time in the past few years, the price setters of the Indian market have been the locals rather than the foreign investors. And this has continued. There's now about $3.5 billion per month of systematic investment flows, so from local investment products directly into the market every single month. And on top of that, there's another $1.5 billion of discretionary flows into the market every month. So there's a strong local bid underpinning the market. The problem is that all this enthusiasm kind of cascaded into this bull market, into this frothy, speculative bull market last year and the year before, with particularly small and mid-cap stocks in focus, trading at extremely high multiples, especially in sectors exposed to the capex boom, capital goods, defense, and valuations just became untenable at that level. So I think it's correct and healthy that there was a reset. I mean, frankly, the market has underperformed the region, but it's not done too badly given the valuations it was at. And the second component is that there has been a cyclical slowdown. With the election of Modi for his third term, the government has turned its attention to fiscal consolidation, because, as I said, during COVID there was a lot of handouts, and it kept the show on the road. But now the government wants to start paying down some of that debt. So if you don't have that strong government capex bid, you're sort of reliant on the private sector to step in. And to date, I think we've all been a bit disappointed at how muted that private sector response has been. At the same time, consumption has been slightly weaker, and there have been reasons for all these things. But what we're seeing now, I think, is a cyclical soft patch in a structural bull story. So looking ahead, what have we got around the corner? Well, already the new Reserve Bank of India governor has cut rates by some 100 basis points cumulatively, and we're expecting more to come. Again, reserve ratio requirements on the banks have been eased, so that gives more room for credit to grow. But you do need the demand for the credit, and at the moment that's subdued. The government has cut the GST, well, it's simplified the GST, the goods and services tax, which is going to lead to a reduction in the overall rate. So that should stimulate consumption, particularly for things like smaller cars and smaller two-wheel bikes, motorbikes. So there are a number of areas where there's going to be definite stimulus in the market for the next 12 months. And next year, you're going to get a phased rise in pay We've got the 8th pay commission coming in next year. It won't all happen at once, but every single central government employee, from civil servants in Delhi to the military to the employees of the Indian railway companies, they will all get significant pay rises. We're talking 30-40%. And again, this won't happen in one go, but it's going to happen, and it will be a positive for consumption. So I'm not terribly worried about India. It's just, it was an expensive market. It's growing into its multiple, but I think the long-term story there is healthy.
I remember 12 months ago, sort of this time last year, I was talking to some of your colleagues in the EMAP investment teams. And back then, my thought was India was tactically challenging, strategically still very attractive, and China was the other way around. Tactically interesting because back then it was super cheap, but strategically still quite challenging. It sounds like that distinction have become a bit more or less clear, or a bit more blurred, in the sense that China, strategically, there are new things happening, especially with AI, that could develop into something more material for investors to work with. For India, as you pointed out right at the end just now, there are some cyclical upturn factors that can make the market attractive for investors, not just for the long term, but also maybe over the next 12 to 18 months. So in that sense, I think, coming back to a really important point, the ability to select stocks and sectors are really the key in investing in these markets and also broader APAC market. The final question I have for you, Mark, is we touched on AI a number of times. We touched on AI in the context of China, how DeepSeek moment has evolved into something bigger and arguably more sustainable for the China market. And if I take a broader view of APAC, clearly Taiwan, South Korea, Japan, even in some Southeast Asian markets like Malaysia, like data centers are starting to emerge as potential points of interest when it comes to AI. How do you see the development of AI, partly linked to the US, but also organically within APAC that creates investment opportunities for you?
Yeah. So the biggest story, without a doubt, has been the demand from the US. And we mentioned the $350 billion number earlier. 75% of AI CapEx broadly comes back to Asia. So whether it's the very high-end TSMC chips that go into NVIDIA's GPUs, whether it's the memory from the high bandwidth memory from Hynix, whether it's the servers, the AI servers, the optical equipment, the cooling equipment, the PCBs, all these different tech components are overwhelmingly manufactured in Japan, Taiwan, and Korea. So the Asian markets have been massive beneficiaries of this boom in spending. Now, this comes with a health warning, of course, because if this spending slows down, and we've had several scares over AI capex and what returns ultimately get generated and what are the use cases, and is this a massive misallocation of capital? Who knows? But at the moment, the taps are on and the money is flowing, and a lot of Asian companies are benefiting from it. So I think we need to be mindful of valuations and how frothy and exuberant the market becomes in this space, because many of us have seen this movie before in the sort of dot-com period. And we have this debate constantly of how different is it, how real, how sustainable is this investment, how real are the productivity uplifts that AI is going to generate. And obviously none of us have all the answers to this yet. So that's part of it. The other part of it is, again, going back to China, the internal development of the AI ecosystem in China. And China is the only other market in the world besides the US where you can credibly say you're going to have full stack AI providers. And by full stack, which is the buzzword of the moment, we mean companies that provide the large language models, that are also the cloud service providers, that also design their own chips, and that also have their own applications. So China is the other market where we're at a much earlier stage, or in the sense that the capex is only now really ramping up. But again, that's seen as an alternative to the US AI companies.
Well, we've covered a lot of ground today. But are there any particular markets or sectors that we have not discussed today that you feel particularly excited about or concerned about?
Yeah, so I'll give two examples. I'd say one market that has done very well this year has been Korea. And it's done very well this year, partly because it did very badly last year. And it did badly because Samsung missed out on the high bandwidth memory qualification with NVIDIA. So there was biggest stock in the market underperformed. Secondly, politics in Korea was a disaster last year. This year, we've got stable politics. We've got a more reform-minded government, at least in terms of market-friendly reforms, improving corporate governance, improving shareholder rights, taking a leaf out of the Japanese playbook to improve corporate governance, shareholder returns. So that's a very, very useful long-term underpinning for what is still basically a cheap market. And then on top of that, you've got sectors within Korea that are particularly geared to some of the big themes of the day. So it's not just technology, hardware, and memory. It's also areas like power equipment, because part of this AI revolution means a massive pickup in demand for energy, and power equipment in Korea is very competitive. Secondly, shipbuilding. The US is for the first time outsourcing naval construction and naval repairs to Korean shipyards. So there's a lot of investment and consolidation going on within Korean shipyards. Defense in Korea, Korea is obviously not a wartime economy, but it has pretty unique threats, which has led to the build-up of very, very advanced yet cost-effective defense capabilities. And so there are very strong defense companies in Korea that are now benefiting from this global rise in defense spending. So I'd say Korea is an interesting one to stay on top of. Areas that I'm worried about, I would say, largely are in Southeast Asia. So Southeast Asia naturally should have been, and were to an extent, Southeast Asian markets beneficiaries of the China Plus One strategy. So this wall of foreign direct investment that went in to diversify supply chains. Now that has happened, but at the same time, you've got US tariffs, which impede their competitiveness on the one hand. Then you've got Chinese, very, very high quality, cheap Chinese manufacturers that are flooding those markets and prevent domestic manufacturers from really being able to compete. Layer on top of that, bad politics. Just look at the turmoil in Thailand, the change of government in Indonesia. So you've got bad policy making, difficult competitive dynamics, and I think that's a real challenge for a lot of these sort of emerging markets, middle income markets, where you wonder where is the next step in development going to come from. Because wherever it's worked, particularly in North Asia, where we've seen it happen, you need to develop that high-end manufacturing capability. You need to move up the value chain. And right now, it's difficult to see that happen in some of those Southeast Asian markets.
Yeah, I think one of the conversations I've had with a US tech portfolio manager was the potential development of robots, humanoid robots, which in a way, potentially, this could be a conversation 10 years from now, where manufacturing is no longer a labor-intensive process. It could be replaced by robots and automation. And that means a lot of so-called the demographic dividends of emerging markets may not be a dividend anymore. So that's something these governments need to take into account. Mark, thank you very much for your time and for your insights. It's super interesting, and hopefully we can have you again before the end of the year or around the year.
Look forward to it.
Thank you.
Thank you.
So thanks for listening. If you enjoyed this podcast, please share this with your friends and colleagues, and of course, consider subscribing. If you have any questions that you'd like to ask us on this podcast, please reach out to your JP Morgan Asset Management client advisor. I'm Tai Hui. I'll see you in the next episode to discuss what's on the investment minds. Meanwhile, stay informed and stay invested.
This This content is a general communication being provided for informational purposes only. It is educational in nature and not designed to be taken as advice or a recommendation for any specific investment product, strategy, plan, feature, or other purpose in any jurisdiction, nor is it a commitment from JP Morgan Asset Management or any of its subsidiaries to participate in any of the transactions mentioned herein. Any examples used are generic, hypothetical, and for illustration purposes only. This material does not contain sufficient information to support an investment decision, and it should not be relied upon by you in evaluating the merits of investing in any securities or products. In addition, users should make an independent assessment of the legal, regulatory, tax, credit, and accounting implications and determine, together with their own financial professional, if any investment mentioned herein is believed to be appropriate to their personal goals. Investors should ensure that they obtain all available relevant information before making any investment. Any forecasts, figures, opinions, or investment techniques and strategies set out are for information purposes only based on certain assumptions and current market conditions, and are subject to change without prior notice. All information presented herein is considered to be accurate at the time of production, but no warranty of accuracy is given and no liability in respect of any error or omission is accepted. It should be noted that investment involves risks. The value of investments and the income from them may fluctuate in accordance with market conditions and taxation agreements, and investors may not get back the full amount invested. Both past performance and yields are not reliable indicators of current and future results. JP Morgan Asset Management is the brand for the asset management business of JP Morgan Chase and Company and its affiliates worldwide.